Parshvanath just after Diwali. So this is how the JCF is spearheading with the blessings of our mentor Nai Padma Sagarji Maharaj side. And about other initiative, we are into lot of charitable and philanthropic activities also. During the period of COVID, we did provide financial assistance to chartered accountants families who were in need at a period time of crisis. And we also did some anukampa of providing PPE kits and other accessories to various BMC hospitals in Mumbai. So, with these words today about this series, Embrace the Changes. Friends, last year also we had the similar series which was highly successful, and with that we have started this year also, and this is going to be a repetitive phenomenon every year. So every financial year, after end of financial year in first month April and May, we would be coming out with similar lecture series. And you all will be aware that earlier we had tea time with JCF, a series of almost 2 weeks. So that was also instant hit for providing young faculty members an opportunity and platform in the form of JCF to bring out their talent. We also did Dharma Charcha session during Paryushan since last 3 years. And again, this kind of activities will be continuing for the benefit of all the members. So my request is to friends, spread the word and request all, motivate all your friends, JNCA friends to become life member of JCF. With this, now I welcome today's chairman of the session, CA Rajesh Sanghvi, and also our learned speaker friend, our committee colleague, Shardul Shah. Friends, they both are highly acknowledged experts in that particular field of black money laws. And we would like to be immensely benefited by their wide experience and expertise in this particular field. Friends, I welcome you all also to this initiative of JCF, Embrace the New Changes. Shami, please carry on.
Thank you, sir. Thank you, Amrit sir, for your insights. It was very insightful for all our participants. With this, we take our session forward. Before starting, I would request Rajesh Sanghvi sir to give his views. But before he could take up the session, I would take the privilege to have and read his brief profile. He is a proprietor of R. Sanghvi and Company Chartered Accountants practicing since last 33 years at Bandra, Mumbai. His areas of practice are income tax, GST, PMLA, Benami Act laws, trust documentation and drafting, especially property related materials, FCRA, RERA, cooperative societies and allied laws like stamp duty, etc. After completing his chartered accountant, he did his post-qualification management course from ICAI and also done his management course from NMIS and Wellinkers at Mumbai. Risk management and foreign exchange from World Trade Center and finance from IC, Institute of Chartered Finance Analyst of India. He was the 35th All India rank holder in the final CA exam in May 87 and the second All India rank holder in management accountancy from ICAI. He also have got honors in finance course of ICFAI and honors from World Trade Center course in Forex. He also submitted paper on dollarization, that is converting our currency from rupee to dollar. He has given various lectures on topic like FAHMA in a day-to-day management, PMLA, trust, money laundering act, black money, Benami, RERA, etc., etc. So with this brief introduction, I request Rajesh sir to take the session forward.
Thank you, Charmi. That was very kind of you. Uh, just a correction. I hope I'm audible enough.
Yes, sir.
Reasonably audible enough. Okay.
Yes.
Thank you, Jai Jirendra Sabhiko. And that was very kind of you, Charmi. Of course, we're all students of law, students of accountancy, and students of economics also. And right from, friends, I can say right from 2015 onwards, 2015 से 15, 16, 17, 18, we've been seeing a whole lot of different type of laws coming into force, and extreme amount of far-sightedness is being seen when these laws have been promulgated. And one of such a law, which I would not call it as a revenue generating law, it is revenue generating, no doubt about it, but it is more of a punitive law. It's a pretty harsh law, and that is the one which is going to be spoken today by my brother, my friend, and my colleague, CA Shardul, who's an expert in this field. Of course, the name of the law is pretty long enough. Something like the black money, undisclosed foreign income and assets, and imposition of tax 2015. Let's call it as Black Money Act. In fact, for the first time, we are seeing a law which has the very in its phraseology, in the name itself, there is a word black money. So obviously, it's concerning black money. A beautiful piece of legislation which ought to have come in years back, but it came in 2015. And in hindsight, यानी कि अगर हम आज देखें कि एक के बाद एक जितने भी लॉज को जिस तरह लाए गए हैं, ब्लैक मनी एक्ट 2015 में, उसके बाद आईडीएस स्कीम आया था, उसके बाद 1 November 2016 को बेनामी एक्ट लेके आए थे, 17 में वी हैव द जीएसटी एंड आईबीसी एंड सो मेनी थिंग्स हैव बीन कमिंग फॉर. तो व्हेन यू सी इन हाइंडसाइट, all the legislations are in place, and some of the laws like this one, the Black Money Act, are having extremely harsh provisions at time, which CA Shardul may comment upon. And when we read the provisions, we really felt कि oh my god, अगर आपने रिटर्न में फॉरेन एसेट मॉड्यूल में कुछ लिखना भूल गए गलती से, बिकॉज टिपिकली लेट्स से द जूनियर्स आर फिलिंग इन द रिटर्न्स ऑनलाइन, और कोई गलती हो गई जाने अनजाने में, and you don't disclose an asset, or you don't properly disclose an asset, or you don't file your return at all under 139(1), even if you're liable, तो क्या आपके ऊपर 10-10 लाख और इस टाइप की पेनल्टीज लग जाएगी? And the law itself speaks about 30% tax and 90% penalty. That means 120%. So we're talking of provisions which seem to be on the face of it very, very draconian. And retrospective applicability, prospective to of course hai, how many years in the past can they go, etc., etc., or the foreign assets detected by the officer, so on the date on the 1st April of that particular year of deduction, उसकी market value पे लगा देंगे. And a lot of fascinating questions coming to mind, and how the courts, how the AOs, how the CIT appeals, first appellate, and how the second appellate authorities, ITAT, with some recent judgments, how have they interpreted this law? How have they discussed about words of shall and may, और किस तरह इसके essence को उन्होंने implement किया है? It's a beautiful area of understanding also, and a great area of practice also. CA Shardul is going to dwell upon this topic and touch upon all these issues. I wish him all the best, and he is a great speaker, a great person to listen to. So all the best, Shardul ji, and thank you so much, Charmi, for giving me this opportunity. Thank you.
Thank you, Rajesh sir, for your wonderful insights. This have paved the way for our excellent session by CA Shardul Shah. So before starting and giving Shardul sir the opportunity to speak, let me take the opportunity to introduce him. He was an article with MA Shah and Company Chartered Accountants, and presently working as a partner in the same firm. He has worked with the Nishit Desai Associates for a period of 2 years. His association with WIRC for Region Council member of WIRC for the term 2007 to 10, 10 to 13, and 13 to 16. He was a secretary of WIRC for the year 11-12, chairman of Vikasa in 99-2000, and have given lectures to final CA students on different topics of taxation, Sydenham College, Mumbai, organized by WIRC of ICI jointly with BCAS. He is a chairman of Finance and Tender Committee of Mumbai Cricket Association, co-chairman of Young Entrepreneur Wing of Indian Merchant Chamber, vice president of Jain CA Federation, secretary of Indo-American Society, past president of Kala Gujari Junior, which promotes art and culture among youngsters. He is also faculty at the ICI course on certificate course of an PMLA, Register of Companies, Customs and GST Department, National Academy of Direct Tax, Jai Hind College, HR and Hinduja. He is also a member of Board of Studies of Accounting Studies at Nagindas Khandwala College and actively associate with BCAS CTC, life paper of GSTPM and AIFTP. Is author of various books and articles. For example, FAQs on charitable trust published by JCAF in 2020 and second edition in 2021. A handbook of PNA published by the CTC, referencer on FEMA published by ICAI, WIRC of ICI Union Budget publication of 2016, 17 and 22. He has also presented various papers including international conference titled Issues and Challenges in Startups, regular contributor at BCS, national conference titled Reforms in Banking Sector. And he is also regularly participant in career counseling events organized by ICI, Rotary clubs, schools, etc. With this brief introduction, I welcome you, sir. And before taking the session, I would present you with a token of gratitude. And this is a small token of gratitude from JCAF. So now I request you, sir, to take over the session. Thank you, sir.
Thank you, Charmi. Respected Chairman of the session, Rajesh Bhai, respected Secretary of JCAF, Amrit Bhai, respected various seniors I can see here, including Tarachan Bafna ji, Mahavir ji, Vanna ji, very dear friend of mine, various Mr. Bafna, and various friends who are present here, including a lot of committee members of JCAF. At the outset, thank you very much, JCF, for giving me this opportunity of sharing whatever little bit knowledge I have on the subject. But I can say without any hesitation, there are seniors better than me like Rajesh Bhai and many more who are present here today who will be able to enrich us better. However, whatever little bit of knowledge I have on the subject, and we will discuss it, and let us try to put whatever thoughts we have on the table, and let us try to make the session as interactive as possible. You can put up your hands at any point of time, or you can probably take up the questions at the end, time permitting. So I'll just give you the perspective. My relationship with JCF goes probably more than 15 years ago, when Maharaj Sahib was actively doing things for not only chartered accountants but people at large. And I must once again compliment and give my full courtesy and regards to Nai Padmasagar Maharaj Sahib. It's only because of the blessings of our gurus and blessings of seniors like Mr. Porwal that JCF is in extremely good hands, and they are doing extremely good work. So once again, compliments to JCF, and once again with the blessings of Maharaj Sahib, I think we proceed ahead. And once again, I would like to place on record, many compliments to the organizing team who have made this session possible. And I'm sure all the sessions which have been done in the past were very exciting. And when Hiral Bhai called me up a few days ago, and I told him about this topic, he was very happy about it and he accepted it. So once again, compliments to Hiral Bhai and the entire team of JCF. I also would like to express that we have an excellent conference coming up on 28th of May. In case some of you have been following the JCF conferences, is our annual day, and I request all of you to please join the annual day as well as the celebrations which are going to come as far as JCF annual day is concerned. Coming back to the subject proper, friends, the subject allocated to me is on Black Money Act, and as Rajesh Bhai rightly mentioned, it is definitely a very harsh law, It is unfortunate that over a period of time that India has been bringing out with such harsh amendments and legislations in place. But be it as it may, we have to live with it. And the kind of precedents and the kind of the kind of view which the various departmental colleagues, for example, the assessing officer or even CIT appeals, or for that matter, even ITET is taking is very, very harsh view. And in this background or this line, something that we all as chartered accountants need to be very careful of how we are representing the matter and how we are strategizing the case for the benefit of our clients. It is essential for us to know that if we do not plan ourselves properly, I think then the case could be very, very different. And it is very important for us to know that what exactly is happening at the time of assessments and what exactly is happening at the time of various levels of the proceedings. So I would like to share my presentation, and if there are any doubts or if there are any queries, you please do let me know. As rightfully mentioned by Rajesh Bhai, this act was probably brought about with a view to stop the unaccounted money, and especially that kind of money which is lying abroad. And so this was the background under which this act was brought into place. And this act was brought basically as mentioned earlier. The title of the act, unfortunately, is very, very long. So it is called the Black Money, Undisclosed Foreign Income and Assets and Imposition of Tax Act 2015. For the sake of convenience, now we will say it is now the BMA Act or the Black Money Act. And basically it had the target, and its target was only for the foreign income and foreign assets which were acquired by a restricted class of residents, and which were liable to be taxed on global income as residents and also for ordinary residents. So please remember this. This act was primarily brought in place for residents to tax their global income. Mainly because they either did not file return, or the return was filed but they did not disclose the relevant foreign assets or foreign income. And basically, yes, the income which is proposed to be brought to be taxed under this act will be the year in which the assets comes to the notice of the assessing officer, irrespective of the year to which the income or the asset relates. This has not been made as part of Income Tax Act because the long arm of the Income Tax Act does not stretch beyond the time period. As we all know, now it has been restricted to either 3 years or 6 years. In case of assets which are beyond undisclosed assets of more than 50 lakhs, then it goes to 10 years. But this particular act, there is no time limit, so it can go indefinitely in the past. So the timeline, what we find, it does not come in between of tackling of this kind of tax evasion, primarily with regards to resident Indians and including a lot of government employees. So any kind of fraud or any kind of system which is being brought to tax is going to be through the BMA. And it is, please remember, BMA is a criminal offense, and it is the same, this kind of treatment is similarly adopted in other countries, for example, European countries, except France, which continues to treat tax evasion as a civil offense. So any action which is taken under this act, that is this BMA Act, for any unreported income, we are finding that the rates of tax, unfortunately, for BMA is kept at 30%, but there is an automatic penalty of 90%, which adds up to 120%. So this is definitely very, very draconian. But what we are finding is, unfortunately, in addition to this liability, which comes or which may come ultimately to confiscation, there is a further liability by way of prosecution, and also could be with imprisonment for 10 years. Imprisonment for a period which may be sometimes extended from 7 to 10 years is for abatement and other incidental offenses. For example, not answering the queries which are posed, or for not responding to the notice. So definitely this law is draconian, and the feature of this act runs contrary to the accepted principles which would have met the challenges on ground of constitutionality. So the law has been accompanied by the, so what happens, this law is administered by the income tax department, and the departmental efforts are now succeeding by being able to get information about the Indian investments abroad through various exchange of information. Now what is happening, the data or the information is coming on automatic basis because of the DTAA and because of various multilateral and bilateral agreements. This law is now accompanied by a publicity given to the new policy of prosecution without awaiting for the outcome of pending tax disputes. So please remember that irrespective of the outcome of the tax disputes, prosecution can be launched under BMA. So all this is designed to warn the taxpayers about the dangers of tax evasion, and it's not only confined to tax evasion, but with reference to any foreign income or foreign assets. So basically what the government is trying to do is trying to get a carrot and stick approach, and thereby the BMA, they are trying to persuade all the people to surrender the foreign money or foreign asset voluntary by coming up and then accepting the same. The tax, as you know, is a independent. This liability under BMA is an independent liability, except for where there are pending proceedings, which have now come into force from 1st of July 2015. So this law, as you all have seen, is definitely going to be a strict law and also going to be strictly enforced by the government of India. We will now directly jump into the slides for the benefit of all of you. Great. Okay, so what is the preamble to this act? It's very, very important. This is an act to make, it is an act to deal with the provisions of the problem of black money. As you all know, there is undisclosed foreign income and assets. So please remember, Black Money Act primarily deals with the assets and income abroad. Please remember that. And what is the procedure for dealing with such income and assets which are lying abroad? Also, this act provides for imposition of tax on any undisclosed foreign income and assets which are held outside India, and any other matters which are connected, incidental thereto, is also going to be covered under BMA. What is the applicability of this particular act? So as we all have seen, the applicability is from 1st of April 2016, and the objective is to tax undisclosed foreign income and assets which were acquired from undisclosed foreign incomes, to punish all the persons which are indulging in illegitimate means of generating the black money and also causing the loss to the revenue, to prevent illegitimate income and assets kept outside India and from being utilized in a manner which are detrimental to the India's social, economic, and strategic interests, and also the national security. So this is an overall objective of the PMLA, and we see that this particular act has been made, and we will try to see some of the amendments which have been happening of late, and these amendments are only to further disincentivize people from keeping any money abroad. So what is the structure of this particular act? BMA has 88 sections divided into various chapters, 7 chapters. Basically, the first is being of primary chapter. Second is on the basis of the charge. Third is tax management. Fourth is on penalties. Fifth chapter is on offenses and prosecution. Sixth is on one-time disclosure. And seventh is general in nature. So what we see is typically there are 88 sections under BMA, and how the income tax department is going to take care of each one of them is something which we have to see. So this is a brief chart which talks about the undisclosed foreign income and assets. So I will just explain this chart. In case of a person, and the person is resident during the previous year, that means he is resident under the Income Tax Act during the preceding year. If the answer is yes, and again, if the person is a resident but not ordinary resident, then yes, then definitely this act is applicable. In case of a resident but not ordinary resident, then definitely this act is not applicable. But in case a person is not resident during the year, then it is not applicable. In case of resident and not ordinary resident, as we saw earlier, this act has a limited applicability. But we will see in slides to come, there has been amendments to the BMA Act, where in certain cases, in case a person becomes a non-resident subsequently, how this particular act can attract those people, because during the time when they acquired the assets, they were actually residents. Does not matter that now they become non-residents, but the time when they had generated that asset or undisclosed income, if they were residents in the country, then definitely this act is going to be applicable to them. Some of the important sections which we will take up today, and which probably needs a lot of understanding, is as we see in any other act also, is basically section 2. As we all know, section 2 is which is the definition section, and this particular section has various clauses, but the important clause under section 2, which is definition clause, is section 2 into brackets 11, which is a very, very important section, and which talks about undisclosed assets located outside India. Please remember, friends, section 211 is very, very critical. So if you are hit under 211, then you are really badly hit. So
you have shared the screen or what?
You can't see it?
No, PPT is not visible.
So sorry, just 1 minute. Please wait.
Yeah.
Now you can see?
F5 करी ना आपने? Slideshow.
Now you can see?
Yes, very much, and thank you. Sorry for the interruption.
Really sorry, I didn't know. I thought my slides are being seen.
I'm so sorry. I read the chat just now, so I intervened.
Thank you. Thank you. So as we discussed, friends, section 211 of this act is very, very important, because 211 talks about what is undisclosed assets located outside India. So undisclosed assets located outside India mean any asset, including financial interest in any entity which is located outside India, held by the assessee in his name or in respect of which he is the beneficial owner, and he has no explanation about the source of investments in such asset, or the explanation given by him is, in the opinion of the AO, unsatisfactory. So this is very critical, that if there is undisclosed asset, whether you are hit by section 211. Unfortunately, what we read during the course of section 211, there is not much, you can go deeper into it. For example, when we read section 211 carefully, we see they talk about the financial interest in an entity. What does financial interest in any entity mean? So again, it is not very clear under the BMA Act or under the Income Tax Act. So we have made representations multiple times to the Government of India, but we are yet awaiting the clarity of what is financial interest. Subsequently, they also talk about that the assessing officer has been empowered under the BMA to question the fair market value of the foreign asset which is undisclosed by the assessee in the return of income. And what are we talking about? Whether the AO is actually empowered and whether he can actually question the fair market value of the foreign asset which is disclosed, or a valuation report which is given by the assessee. So that again is under the Pandora's box. Which valuation report are you going to take credence of, and what is the, how do you verify the fair market value as supported by the assessee as far as valuation is concerned? So this again is something which is tricky and something which is definitely going to be tried and tested over a period of time. The courts will definitely take a view on about as far as valuation is concerned. Also, I would like to discuss here section 212. Section 212 discusses about undisclosed foreign income and asset. So section 212 talks about undisclosed foreign income and asset means the total amount of undisclosed income an assessee has from a source located outside India, and the value of the undisclosed asset located outside India referred to in section 4 and computed in the manner which is laid down in section 5. So again, section 4 and section 5 becomes very, very important. We will go to these sections in much minute details in slides to come. Also importantly, section 4 becomes important because what section 4 talks about is the scope of the total undisclosed foreign income and asset. So subject to the provisions of BMA, what is undisclosed foreign income and assets? So it is basically a sum total of all the assets and all the income which are located outside India and which have not been disclosed by the return of income, have not been, which has never been furnished to the income tax department or will also not be furnished. Subsequently, any income from a source which is outside India in respect of which return which was supposed to be filed but you have not filed it under section 139, and the value of such income as well as value of such undisclosed asset is something which is proposed to be taxed under BMA under section 4.
Shardul, please change the slide. Please change the slide.
No, we are yet on this slide only, sir. Section 4.3.
Okay.
That is exactly what I'm talking about. That is the fourth bullet.
Okay, fine.
So under section 4.2, what we are talking about is a very important aspect that notwithstanding anything which is contained in subsection 1, any variation which is made in the income from a source which is outside India in the assessment year or the reassessment of the total income of any previous year, the assessee under the Income Tax Act in accordance with provisions of section 29 to 43C or section 57 to 59 or section 92C of the Income Tax Act shall not be included in the undisclosed foreign income. What we're trying to see is what the income tax, what the BMA is talking about in section 4.2 is any such income or any variation which is made, then such kind of variation will be excluded. Very importantly, under section 4.3, they talk about income which is included in undisclosed foreign income shall not form part of the Income Tax Act. So they are talking about if any income is disclosed under BMA Act, then it will not be included under the Income Tax Act. What about vice versa? Unfortunately, it is not the case. So the income which is included in undisclosed foreign income under BMA will not become part of the Income Tax Act. But what about vice versa? Any income which is disclosed under the Income Tax Act also should not come under BMA. But this view is not taken by the department, and it's something which is highly debated as of today. Although the BMA Act came much later in force in 2015, but the department is taking a view that income has to be taxed under BMA, and definitely the tax, the penalty, whatever you paid under BMA, the credit will be given under income tax. But vice versa, they are not taking the position, meaning thereby there is a live case which I am handling under Income Tax Act. We have made the payment of tax, we have made penalty, but even then the BMA proceedings are carrying on and there is no answer to that. They want us to pay under that act as well. So again, going back to the act, some of the brief salient features of this act, as we discussed, undisclosed foreign income and assets of an ordinary resident would be taxed under this BMA and not under the normal provisions of the IT Act. Unfortunately, this 16 years of time period or the time limit which is prescribed under the Income Tax Act is there is no time limit to tax the foreign income or asset escaping assessment under BMA. There is a flat 30% tax on the total undisclosed foreign income and assets, no surcharge or educational tax. There is no wealth tax. There is interest as per section 40 of the Act. I will just briefly read section 40 of the Act, but unfortunately there is no credit which is available. So meaning we are talking about interest for default in furnishing return and payment or deferment of advance tax. Where the assessee has any income from a source outside India which has not been disclosed in the return furnished under section 139, or the return of income has not been furnished under the subsection, interest shall be chargeable in accordance with sections 234A of the Income Tax Act. If the assessee has any undisclosed income from a source outside India and advance tax on such income has not been paid, then obviously interest shall be calculated in terms of 234B and C. So interest also, there will be a hit in addition to the tax. Penalty, as we have seen earlier, it's very draconian. It goes all the way 3 times. So total amount comes to almost 120%. So there was a one-time window which was available for this compliance, but unfortunately that window was shut in 2016. What is happening now, as you know, friends, the Indian government is entering into various agreements with foreign countries. One of the classic agreements is now with Switzerland, that we'll see in slides to come. But the central government is continuously entering into agreements. Mainly, it's to avoid double taxation. Secondly, is for exchange of information, for prevention of evasion or avoidance of tax, mainly for undisclosed assets and income which are lying abroad, for investigation of cases for evasion or for avoidance of tax of undisclosed foreign income. These agreements are also for recovery of tax, for carrying out any other purpose. So agreements with various countries are happening on a regular basis, and these agreements will only enhance the capability of the government of India to collect more and more tax. The charging sections, friends, as we all know, under BMA is section 3, and as we all know, under the Income Tax Act, the charging section is section 5. So this section, section 3, is very, very important, which is a charge of tax. What it says, section 3 into brackets 1, there shall be charged on every assessee for every assessment year commencing on or after 1st day of April 2016, subject to provisions of BMA, a tax in respect of his undisclosed foreign income and assets of the previous year at the rate of 30% of such undisclosed income and assets, provided that an undisclosed asset located outside India shall be charged to tax on its value in the previous year in which such assets comes to the notice of the assessing officer. For the purpose of this section, that is section 3 into brackets 2, the value of the undisclosed assets means the fair market value of the assets, including the financial interest in any entity determined in the manner as may be prescribed. So what we understand, friends, is it does not matter when you have acquired the assets. The most important aspect as far as section 3 into bracket 1 is the year in which the assessing officer comes to know about this particular asset. That will be the year in the under which these particular assets will be charged to tax, and that will be the date which will be relevant under the BMA. So under BMA, non-disclosed foreign income under return of income is the triggering point, section 4. But the question arises, friends, what if the tax has been paid on such income? For example, what happens to the credit on taxes paid in the foreign jurisdiction? Unfortunately, there's not much clarity on that. exemption from VAT tax implications in respect of undisclosed foreign assets which are lying outside India, not voluntarily disclosed but detected by the tax officer and assessed to tax. In case of a non-resident becoming a resident, the income for the past years may arguably not be treated as undisclosed foreign income, but such persons needs to be mindful about the consequences with reference to the value of the undisclosed foreign assets which are lying outside India at the time when he becomes a resident. Now we go to an important aspect which is called computation. The computation of the total undisclosed foreign income and asset. Friends, this is given under section 5 of BMA, and under section 5.1 it says how to compute the undisclosed total income of the asset in any previous year. So it says obviously about all the income and all the undisclosed income as well as undisclosed asset. But while calculating the same, please remember you will not get any deduction in respect of any expenditure or allowance or set off or any loss. No loss will be available to the assessee whether or not it is allowable in accordance with the provisions of the Income Tax Act. So any income which has been assessed to tax in any assessment year under the Income Tax Act prior to the assessment year into which this act applies, or which is assessable or which has been assessed to tax in any assessment year shall be reduced. So what they are saying is any income which has already been assessed or anything which is accessible for the tax, accessible for taxes for any assessment year, but it is prior to the BMA coming into act, it will be reduced from the value of the undisclosed asset which is located outside India. Only if there is a clause, it means there is a condition. They are saying that under section 5 into brackets 1, the clause is only if the assessee provides information, evidence to the satisfaction of the AO that the assets have been acquired from the assets or the income which has been accessible or has been already assessed, as the case may be. So as we saw, there is sometimes a possibility of a deduction, sometimes there is a possibility of no deduction. The amount of deduction which we just talked about in case of an immovable property shall be the amount which bears to the value of the asset as on the first day of the financial year in which it comes to the notice of the assessing officer, and again in the same proportion as it's accessible or assessed of the foreign income bears to the total assets of the assessing. So this is something which we just talked about, section 5.1 and 5.2. An illustration for the benefit of all of you friends is, for example, a house property which is located outside India was acquired by the assessee in the period of 2009-10 for 50 lakh rupees. Out of the investment of these 50 lakh rupees, which was assessed to tax in the total income of the previous year, that is 9-10, any undisclosed asset which comes to the assessing officer, for example, in subsequent year in the year 1920, and it comes and at that time the value is 5 crore rupees, please remember then the amount which is chargeable to be taxed is going to be the difference, that is between 5 crores and 50 lakhs, that is 4.5 crores. So this is something, this moment. So this is something which we all have to keep in mind. So typically all the authorities which are having powers under the Income Tax Act are also having powers to the BMA Act. So the proceedings are definitely similar to what we see under the Income Tax Act, and all the proceedings before these tax authorities are similarly the judicial proceedings, and obviously the tax authorities are the similar which are giving the meaning under section 193 and section 228 for the purposes of the section 196 of the Indian Penal Code. So every tax authority shall be deemed to be a civil code for the purposes of the section 195, but not for the purposes of chapter 26 of Code of Criminal Procedure Code of 1973. Now we come to assessment. Very, very interesting, friends. The assessment under BMA happens under section 10 into brackets 1. So the first time also the notice you will get will be under this section. So for the purposes of making an assessment or reassessment under BMA, the AO on receipt of any information from income tax authority under this Income Tax Act or any other authority under any law for the time being in force, or coming to any information which comes to his notice, he will serve on any person on notice. So notice will come under section 10(1), requiring that person to come on a date specified or to produce such accounts or documents or give evidence to the assessing officer as he may require for the purposes of BMA. And also he can keep giving notices under section 10 into brackets 1. Under section 10 into brackets 2, he can also make various inquiries as he considers necessary for the purpose of obtaining any information in respect of undisclosed foreign income or asset in respect of any person for the relevant financial year. So after giving all these notices, please remember the order ultimately is passed under section 10(3). Under section 10(3), the assessing officer, after considering all accounts, documents as he has obtained under section 10 into brackets 1, and after taking into account any relevant material which he has gathered under section 10(2), he will pass an order in writing. He will assess the undisclosed foreign income and assets, and he will determine the amount of tax which is payable by the assessee. If the assessee fails to comply with any of the notices which are given under section 10(1), the AO, after taking into consideration all the material, and he will give an opportunity to the assessee of being heard, and then he will make an assessment of undisclosed foreign income and assets on the basis of the best judgment. As we have a best judgment under income tax under section 144, under section 10 into brackets 4, the assessing officer under BMA can also make assessment to the best of the information available to him. So coming to some of the recent, the nuances which have come up for discussion is about a Swiss test. So what has happened recently is, although we have understood that India and Switzerland have entered into an agreement for regular exchange of information, the Swiss government is now becoming very, very careful as well. So what are we talking about? So there are more than half a dozen appeals which are coming up. So we are talking about a time anywhere in the year 2022 for hearing to stop the Swiss authorities from sharing information with India on the grounds that they do not comply with the harsh law which is applied retrospectively. It can only be used to impose stricter criminal sanctions than those that would have been possible at the time of the offenses where it was committed. So what they're trying to say is, any act which is again retrospective in nature is something which is incompatible with the Swiss legal system and values. That's why now the entire thing is coming up before the government of Switzerland. The Swiss Supreme Court, in a ruling last year, has observed that in accordance with the principles of speciality, information which is obtained through the administrative assistance can only be used for tax purposes mentioned in the agreement. The current provision of exchange of information clause under the India-Switzerland tax treaty were agreed way back in the year 2011, while the Black Money Act has only come into force from 2015. So they are talking about whether this, being an act which is criminal in nature, can have a retrospective applicability. Is something which will be tested by the Swiss laws. So what are we talking about? Very importantly, section 51. Section 51 is something which we all need to know under the BMA Act. Section 51 talks about punishment for willful attempt to evade tax. Under section 5, under subsection 1 of section 51, it says that if a person being a resident other than not ordinary resident in India within the meaning of clause 6 of section 6 of the Income Tax Act willfully attempts in any manner whatsoever to evade any tax, penalty or interest chargeable or imposable under BMA, he shall be punishable with rigorous imprisonment, which shall be not less than 3 years, but which will extend for 10 years with fine. Further, section 51 subsection 2 talks about if a person willfully attempts in any manner whatsoever to evade any payment of tax, penalty or interest under BMA, he shall without prejudice to any penalty that may be imposable on him under any other provisions of this act be punishable with rigorous imprisonment for a term not less than 3 months, but will be extended to 3 years with the discretion of the court, also be liable with fine. Further, subsection 3 of section 51 says, for the purposes of this section, a willful attempt to evade any tax, penalty or interest chargeable or imposable under BMA for the payment thereof shall include a case. So there are various cases. First, if he has in his possession or control of any books of accounts or other documents, being books of accounts or other documents relevant to any proceedings under BMA containing any false entry or statement. Second, he makes or causes to make any false entry or statement in books of entry or other documents. Number 3, he willfully omits, very important friends, he willfully omits or causes to be omitted any relevant entry or statement in books of accounts or other documents. Or 4, subsection 4 of section 51, he causes or any other circumstances to exist which will have the effect of enabling such person to evade any taxes or penalty, interest chargeable under this act or payment thereof. So please remember friends, because of section 51, this is becoming now a trigger which will be tested under the income tax or the Swiss test. What is the punishment for giving the false statement in verification? If a person makes a false statement in any verification under BMA or under any rule, so section 52 talks about this, or he delivers any account or statement which is false and which he knows or believes to be false or does not believe to be true, he shall be punishable with rigorous imprisonment with a term not less than 6 months, which will be extended to 7 years and fine. Please remember, it doesn't stop here. 51, 52, there is also section 53, which says punishment for abatement. If a person abets or induces any other person to make and deliver an account or a statement or declaration relating to tax payable under this act, which is false and which he either knows to be false or does not believe to be true, or commit an offense under subsection 1 of section 51, he shall be punishable with rigorous imprisonment, which shall be not less than 6 months, but be extended to 7 years and fine. So this is very, very important, friends. So section 51, 52 and 53 is something which we talk about: punishment for willful attempt to evade tax, punishment for giving false information, and punishment for abatement. The act, because of these 3 sections, friends, then the Swiss test comes into play. The 2 basic and cardinal rules in the mechanism for information sharing among the nations is that sharing should not be contrary to the public policy. It's very important, friends, public policy of the nation sharing the information. And such nations are also not expected to undertake steps which are in variance with their local laws. So what happens in Switzerland? In the present cases, if the Switzerland were to share the information, if Switzerland knowingly that this could be used by the Indian authorities for the invocation of the criminal law, and that also with retrospective applicability, this would be in violation of their local Swiss public policy. So this is something which is going to be very, very tricky and something which will be now tested by the Swiss courts. Again, something which only time can only say, but I think interesting times are ahead. Friends, some of the other important decisions, as we all know about KM Sharma versus ITO, 254 ITR 772, the Supreme Court. The Supreme Court has decided that various assessments which have already become time barred cannot be revived because the principle that vested rights cannot be divested by a retrospective amendment. Please remember, friends, BMA has sought to be met with different enactment. So BMA is a different enactment and not by a retrospective amendment. BMA is not brought into play by a retrospective amendment. It's different from Benami law. If you see the Benami law, it was brought in a different modified avatar, but again those provisions were called as amendments and retrospective amendments. Unfortunately, the BMA law is a different law and not brought in by a retrospective law. The time limit, therefore, has no relevance to the BMA Act because it is an independent code by itself. The 88 sections are absolutely different by itself. Although all the procedural sections have been borrowed from the Income Tax Act either by incorporation or through cross-reference. Friends, this is very, very interesting decisions which was brought. Again, this is a decision which brings some bit of respite to the assessees. So this was under the BMA Act, and what it says that unless there are sufficient prima facie reasons or at least to doubt the bona fides which are well demonstrated by the assessee, an assessee cannot be visited with penal consequences. So this particular decision is a pro-assessee or a friendly decision which is in favor of the assessee, and it says that as and when the assessee makes the relevant disclosures or it doesn't hide anything, the BMA Act cannot become harsh upon the assessee, and definitely you will have to give relief to the assessee when, as and when he cooperates or brings to knowledge of the department any information proactively. The bona fide actions of the taxpayer must be excluded from the application of provisions, for example, of the stringent provisions of the BMA. So in this case, the assessee was under the bona fide belief that she was not required to disclose the bank account which she was under the impression. So her husband was the signatory. She and her husband were signatory to this undisclosed foreign asset. And in July, the investigative wing of the Mumbai had received an intelligence input regarding this bank account and also about the non-disclosure. A search and seizure operations were followed in the year of 2017, and the matter regarding the foreign bank account, and it contained a balance of UK pounds of 2,34,710 was investigated by the department. Following the operations, she filed a return of income in 2018 containing all the relevant details. So what we are trying to say is there are examples or illustrations that as and when you make the relevant disclosure, you have a favorable order of the tribunal saying that yes, in case relevant information is disclosed, then to that extent BMA will not be applicable to the assessee. This is another interesting judgment of Shrivardhan Mohanty, and this is a writ petition of 2018, that is to 568 of 2018. The High Court judgment has made it clear that this statute, that the BMA Act is absolutely wide, and it includes inherited assets which have not been disclosed. Sometimes the assessees are under the impression that my father, my grandfather, or there is an extended family which is staying abroad, and assets have been bequeathed or given to me by way of will, and which has not been known to me. The courts have become very, very clear upon this particular interpretation, and the High Court has observed that inheritance as an explanation of not disclosing the foreign assets is not an acceptable excuse. It is unacceptable excuse. According to the High Court, the inheritance of asset does not prevent anyone from disclosing the assets in the return of income. Even if foreign assets have not been acquired by the individual by his own action, but have been instead been passed on to him by way of inheritance or gift, it would not detract the authorities from prosecuting him under the BMA Act. So inheritance is something which you cannot take relief from. This is again a very, very interesting decision. This is of Yash Birla, and in the Yash Birla's case, definitely the facts are a little different. So these are basically the wealth tax proceedings which are going on. The tribunal said that Yash Birla was nominated as one of the several beneficiaries of the offshore irrevocable discretionary trust and was not the contributor to the trust structure. And Birla was not a substantial owner of the assets held through the trust and other offshore entities. Bank accounts in foreign jurisdictions pertaining to offshore entities could not be treated as bank accounts of Mr. Yash Birla, even though for PMLA purposes, they have been declared as beneficial owner. So what we are trying to say is there is a beneficial decision which is given in case of Yash Birla's case. Because please remember, friends, you have to understand what are discretionary trusts and what are other trusts. In case of discretionary trust, you have to remember it is on the discretion of the persons, as and when the assets or the same has to be distributed. Unless these assets are actually brought or the money has been actually been distributed in case of discretionary trust, the same cannot be charged to tax. And there is not one but ample examples which we will see that in case of a discretionary trust, it cannot be charged to tax. And the trust being discretionary, the amounts were never, if they are never received, the Supreme Court has upheld. So Supreme Court, a very, very important case. This is CWT versus the estate of His Royal Majesty Vikram Singh of Gondal, 268 CTR 232. That is in 2014. The Supreme Court has upheld the principle that a discretionary trust is the one which gives the beneficiary no right to part with the income of the trust property, but it vests in the trustees a discretionary power to pay him or to apply for his benefit such part of the income as they think fit. In case of a discretionary trust where the share of the beneficiary is indeterminate, the beneficiary has no more than a hope that the discretion will be exercised in his favor. A beneficiary of a discretionary trust does not have any interest in the property of the trust unless the same is distributed or appropriate to the beneficiary. So what we are trying to say, friends, in any kind of discretionary trust, you have no rights. And in 268 CTR 232, the Supreme Court has also said it, that in case of a discretionary trust, you cannot charge the person to tax unless the same has actually been received by the concerned person. So again, a favorable decision which was given to Mr. Yash Birla in this particular case. According to ITAT, this was the Bombay ITAT ruling, the definition of the undisclosed asset in the Black Money Act clearly provides that the assets created out of income assessed in the income tax, which are already taxed, is something to be excluded. So one must keep in mind that some assets which have already been brought to tax or which are already included in the return of income is something which is excluded. Hence, the revenue has already assessed the assets in case of Yash Birla under income tax proceedings up to the previous assessment year, and for the current assessment year, the time for return filing has not yet expired. Hence, the Yash Birla's plea that the issue of notice is premature is tenable, and accordingly, the ITT accepted this proposition in favor of the assessee, a favorable decision. This is another very recent decision of Mr. Jatinder Mehra. The assessee, so what happened in this particular case? So assessee did not own any share capital in case of Watergate Advisors Limited, as well as it also did not control the above company, as he did not have any shareholding or management rights in the company. Merely mentioning the name of the assessee in the account opening form, for which is rebutted by the assessee by filing an affidavit and complete details of the ownership of the bank account, the assessee cannot be held as beneficial owner of such sum. Hence, the solitary fact cannot lead to addition. In absence of any other corroborative evidence of the beneficial ownership, and the assessee over the asset cannot lead to the taxability in the hands of the assessee under the BMA Act. So what we are saying, that just because a person's name is mentioned in the account opening form, and ultimately that is also rebutted by the assessee, that cannot just lead to the assessing being hit by the BMA Act. This is again something which is a very favorable decision in favor of the assessee. What is the data we are talking about? The data, fortunately or unfortunately, doesn't seems to be very, very good. The central government has detected black money of more than 80,000 crore and has brought back almost 4,000 crore as tax and penalty under the BMA. The undisclosed income of more than 8,466 crore has been brought to tax, and penalty of more than 1,200 crore has been levied on account of deposits which have been made in unreported foreign bank accounts, for example, in HSBC cases. Sustained investigations which are conducted in the cases revealed, for example, by ICIJ, have also led to the detection of more than 11,000 crore of credits in undisclosed foreign accounts. Persons and companies whose names have been published in Panama Papers till date, a total undisclosed credit of 20,000 crore have been detected with respect to 930 India-linked entities in the Panama and Paradise paper leaks. While the Income Tax Act can be used to claim a 10-year-old, so you can hit the person up to 10 years under the Income Tax Act. As far as BMA is concerned, as you all know, in case assets are acquired way back also, it can be brought to tax under the BMA. As of the 1st of March 2022, friends, more than 592 notices were already sent under BMA. 110 prosecutions have been launched under BMA. From April 14 to February 22, Income Tax Department conducted search and seizure on 5,865 groups and have seized assets of more than 8,000 crore. The IT department has filed prosecution in 12,000 cases. The courts have convicted 333 persons till date. Friends, earlier there was a conception that NRIs cannot be covered. So expanding the coverage of black money, the BMA, the government through the amendment of 2019-20 has retrospectively included non-resident Indians or NRIs under the BMA Act. The change in definition of the assessee is expected to provide power to the income tax authorities under BMA to take action against those who were residents at the time of acquisition of the undisclosed assets and then turn into non-residents. Friends, believe me, a lot of people have actually done this, and they were trying to become non-residents and thereby trying to avoid BMA. But this amendment of 2019-20 is a very big blow to all of them. Earlier in the budget of 2018-19, the government had also amended the PMLA Act to cover corporate frauds under Section 447 of the Companies Act within the ambit. The perpetrators of fraud were able to avoid the application of PMLA by changing their residency status. The amendment, which is being brought out by the by the Union Budget of 1920, was primarily to plug BMA, and as far as 18-19, primarily the changes to PMLA was to plug the loophole which somehow was not addressed in earlier budgets. So please remember, friends, now BMA is Black Money Act is also covered as a scheduled offense under the PMLA Act, and hence now money laundering action by the ED authorities can be also be initiated on basis of an order passed under the BMA. We'll come how the interplay happens in subsequent slides. What is the future now, friends? The multilateral regime for proactive sharing of financial information, setting up of a special investigating team or a team or black money, SIT on black money was formed in May 2014, which was an enactment of the stringent new black money law which came into force from July 2015 are among the various measures which are now taken by the government to curb the black money. Indians with hidden income in US now may face legal action under the BMA Act also in financial year 2023. According to the internal action plan of CBDT for financial year 23, persons named in the global leaks will be now searched, the show cause notices and also prosecution will be initiated. The tax officials across India have been now instructed to investigate any cases discovered during verification of data which is received on or after 1st April 2022 under the FACTA, under the Automatic Exchange of Information and under the CRS reporting standards. This is very, very interesting and very, very new, friends. So as you have the investigation department under the Income Tax Act, now the Income Tax Department is now created a new Foreign Asset Investigation Unit, FAIU, and now it has stepped up the action on the information it now receives in records from Pandora Papers which are investigated. And now recently, as you know, they have conducted two major search operations that were linked to the global media leak. The first operation was on late Mr. Satish Sharma's, and second on Hiranandani Group. Fortunately or unfortunately, the tax department described both these actions as successful. In case of Satish Sharma's case, he was a protector of two trusts, Jan Jagar Trust, incorporated in 1995 in the Cayman Islands with at least 10 members of his family shown as beneficiaries, and another trust which is called JZ2 Trust in New Zealand, in which his wife Sthetre Sharma was listed as a beneficiary. The trust, the records revealed, have several underlying offshore companies and properties in France and Singapore that were linked as assets. The second major search which has happened in Mumbai recently was on Hiranandani Group. Hiranandani family had set up a BVI entity called as Solitaire Trust. The trust had as many as 25 offshore companies linked to it. The shareholding of these companies was transferred to it with the asset totaling of around 60 million in 2017. Also, what we find now, friends, new courts have also been set up by the CBDT. CBDT has issued a few notifications establishing special courts to prosecute offences relating to black money in the states of Tamil Nadu, Rajasthan and New Delhi. In the first notification, so basically notification after notification, the CBDT has now brought in various additional chief judicial magistrates at various places to prosecute the offences related to section 84 of BMA, and they are now going to prosecute people. I'm sure all of you already know how black money is actually created. For some of you who do not know that, I'm sure you are aware that this is one example of how earlier black money was being created. While there are numerous methods of generating of black money, the underlying premise is that of long-term capital gains. As you all know, friends, now the long-term capital gains have become taxable from 1st of April 2018. Earlier, they were not taxable. So people used to take a lot of advantage because of the shares. A broker and his customer may agree to deal with the broker to sell his client's shares in a penny stock for a while, such as a few rupees. The hitch is that the contract letter sent to the customer is backdated to the previous year. In the meanwhile, the broker has manipulated the company's price by using circular trading which involves two or more brokers selling the shares at higher price than even before. After purchasing the shares for a few rupees a piece, the client gives physical cash to the broker, subsequently distributing it across the accounts. The broker buys the shares back from the customer at a higher price, ensuring a long-term capital gains. Essentially, the broker has returned the customer's funds to him. So the customer gives the cash to the broker. In turn, with the higher price which he sells on the exchange, he sells it on the exchange, and the broker then gives him the check for the sale of the shares. Very, very interesting decision. This is of a chartered accountant called Mr. Dilip Thakkar. As you all know, friends, that the judgments in the tribunal have always been taking different views at different times. This is an ideal example of the same. In case of Mr. Dilip Thakkar, he and his wife, Miss Indira Thakkar, whose father had set up a trust, an offshore trust, having an account in HSBC Geneva. This was the private banking arm of the British Bank. In case of Mr. Dilip Thakkar, the ITAT, a quasi-judicial authority, as you know, has upheld the Income Tax Department's decision to reopen the case. So, in case of Mr. Dilip Thakkar, there was an adverse decision as far as the assessee is concerned. However, just in the same bench of Mumbai ITAT, Mrs. Thakkar, that is in case of Indira Thakkar, the assessee got a favorable judgment that the return cannot be reopened as a time period for the reassessment has long elapsed. The IT department, so what had happened, the IT department had reopened both the cases in 2015 for assessment year 1999-2000, that is financial year beginning from 1st April 1998. According to the tax office, Mr. and Mrs. Dilip Thakkar had derived financial benefits from the maturity proceeds of the State Bank of India's Resurgent India bonds. Popularly, they are called as RIB bonds, which were foreign currency deposits launched in August 1998 to mainly for NRIs with high return of interest. Mr. and Mrs. Thakkar said the investments in these Resurgent Indian bonds were made by the offshore trust, which was set up by Mrs. Thakkar's father. But according to the Income Tax Department, the Overseas Family Trust was merely a colorable device to route the unaccounted money through the Resurgent Indian bonds. And the maturity proceeds of the Resurgent Indian bonds do not constitute at the corpus of the trust. So this was the argument of the department. The Income Tax Act was amended in 2012 to empower the tax authorities to go back and reopen completed tax assessments where the concealed overseas assets were detected up to 16 years as against the 6 years for any other taxpayer. As you all know, there was a Brahmadat ruling of the Delhi High Court, and the judicial interpretation of this amendment was that it can be invoked prospectively and not retrospectively. In other words, the law could be used only in such cases which had not become time barred. So if the information on the foreign deposits in 1999 was unearthed in 2015, reopening was not possible as 1999-2000 assessment year had reached finality in 2006. In case of Indira Thakkar, ITAT stood by the Brahmadat ruling, meaning thereby there cannot be a reopening, describing it as binding precedent on the issue. However, friends, another bench of ITAT giving its ruling just a few days later held that Mr. Dilip Thakkar's matter is differentiated from the High Court, and it did not take into account the key explanation given under Section 149 of the amended Income Tax Act, which gives a retrospective amendment. So the retrospective amendment of Section 149 says that yes, you can go back. So the second ITAT interpretation, the department can go back in 1996-97 also for reopening all assessments. Friends, the takeaway of both the decision is there is definitely going to be much more legal battle in high courts and Supreme Courts. Time will only say that which of these two tribunal decisions is going to be valid. But I can only say that both of them, Mr. Dilip Thakkar will go to High Court as well as the department will go into High Court for giving a favorable order in case of Indira Thakkar. So there is not much of clarity, but on a personal note, I can only say that definitely section 149 of the Income Tax Act, the interpretation of the retrospective amendment is something which has to be looked carefully, and there could be a possibility of section 149 being said as retrospective. In another case, in case of Rasesh Manar Bhansali, this is again a very, very unique case, friends. This gentleman had operated 2 undisclosed foreign bank accounts, and which were closed in October 2008 and May 2011. According to ITAT, the black money law, what is relevant is the date on which the tax authority or the income tax officer, assessing officer, notices the acquisition by the assessee of undisclosed foreign asset located outside India. The year in which it comes to his notice is the year which is relevant. It is immaterial whether it existed at the point of time of taxation or for that purpose, even at the time when the provisions of BMA were there or not. The year in which he came to know is the year which is relevant. In case of Mr. Bhansali's case, this provision of law could come under legal scrutiny, as Article 20 of the Constitution states that one cannot be punished under law which did not exist at the time when the offense was committed. The BMA was passed to overcome the limitations in the IT Act and tax the undisclosed foreign assets parked in foreign accounts and often held through discretionary trust. Mr. Bhansali had undisclosed money of around 1,000 crore in BVI. The department alleged that the money was abroad through a company called Gold Jewel Corporation incorporated in BVI, and Mr. Bhansali was the sole beneficiary. As per IT department, the company was incorporated and was operating accounts through the UBS Singapore. What the ITAT said is very interesting. The assessee claims that he took legal advice immediately on finding of the papers which are relevant to these foreign undisclosed assets. And Mr. Bhansali, in light of the legal advice so obtained, says, I do hereby categorically own up these accounts, the account number so and so to Mr. Rasesh Bhansali and account number so and so belonging to Gold Jewel Corporation. Usually critical upon the department, what the ITT said, in fact, ITT did not accept Mr. Bhansali's proposition. And not only that, they appreciated the income tax department. They appreciated the department by saying they appreciate the way of dealing with the tax evasion cases. In this case, ITAT appreciated the efforts of the tax department and observed that on face of it, the manner in which the intelligence is developed, information is gathered, and the official channels for exchange of information are used is very much creditable. So these are one of the few judgments where I personally believe the ITT could have remanded the matter to the assessing officer. ITT could have given more time to the assessee, but unfortunately no. ITT took a very, very strict view that this cannot be accepted, that last minute acceptance of the account. And not only that, they went forward and appreciated all the efforts which were made by the income tax department. A very, very unique case, but let us wait, because again, these cases again have gone to the High Court and we need to see what happens there as well. So this is what the assessee said. It's very, very unique. He says that only yesterday, while cleaning up the heaps of papers recovered from my father's office, which he sold recently, I found some old papers pertaining to bank accounts, which are photocopies of papers being relied upon against me and my wife. And then he goes ahead and admits that I recollect my father had got me and my wife to sign such papers years back. It is, he says, it must be appreciated. These signed papers are very, very, are the same accounts which have got opened by his father, and reasons are not known. So very unique case. So friends, the idea is whatever foreign assets, foreign income you have, please one has to have full disclosure in Schedule FA of the income tax return. Schedule FA deviates from financial year. Please understand the concept of Schedule FA is different. The concept makes references to the assets which are held during the accounting period to address the concerns, especially the concerns of foreign jurisdictions, because they have adopted the calendar year approach. So these Schedule FA requires all such disclosures also. Schedule FA is designed in a comprehensive manner and solicit details of the foreign depository accounts and foreign custodial accounts as held by assessee over along with the peak balance during the period. Investments in foreign equity and debt, overseas immovable property are some of the facts which would come to one's mind and form part of these disclosure requirements. Financial interest in any foreign entity, whether as an agent, a nominee, attorney, is also to be disclosed in the Schedule FA. Even having a signing authority in a foreign bank account also makes a person which is resident in India, responsible to do such kind of reporting. What about valuation, friends? This is a very, very interesting and important aspect. The crucial aspect is conversion of the value of the foreign assets and income into the Indian rupee. So what we are trying to say, this conversion of the foreign assets into Indian rupee is something which is important. The value of such foreign assets in Schedule FA are required to be disclosed after converting them into INR by applying SBI telegraphic transfer rate, buying rate of the foreign currency as on the date of the peak balance in the account on the date of the investment or closing date of the accounting period. I would also like to mention what are, as far as some of the properties or some of the equity shares, then you will have to get a valuation which is done by an approved government valuer, and this valuation has to be such that it is accepted by the income tax department. Sometimes there could be foreign assets which are held through a company, ideally through BVI or Cayman Islands or through Jersey. Typically, these are held through a company and there is only one share in the company, and that one share could be beneficially owned by a resident Indian, and that company sole asset could be an immovable property which is either lying in UK or any other country. So the value of that one particular asset, one particular share, is not the value which is £1 or $1 which is used to acquire that particular share of the particular asset, but the fair market value of the asset which is determined through the valuation officer is something which the authorities under BMA Act have been taxing. What about the interplay between BMA and FEMA? Very interestingly, friends, irrespective of the violation of FEMA, if the funds or assets have been held abroad, have not been disclosed, then the BMA and this Act and its provisions come into play. Therefore, it is not the case of setting into motion FEMA or BMA. Both will set into motion together. I give you an example. So this is one case where we are representing before the FEMA authorities in the ED. So this is a classic case of exchange of information between India and UAE, where the information came into the knowledge of the government of India and passed it on through the FIU to the ED authorities. And what the ED authorities then did is they not only did a provisional attachment of the property in India, but at the same time notices were sent to the same person through the income tax department under BMA. So what is happening now is continuous exchange of information between the income tax authorities and the ED authorities, and also vice versa. It is the obligation of the statutory authorities to trigger the law into motion as and when it comes into the public domain. So apart from BMA and FEMA, there is also now an interplay between BMA and PML, because now BMA has become, any offense under BMA has become a scheduled offense. apart from prescribing more stringent and penal consequences under the BMA Act, now the BMA law has also been included under the PMLA as a scheduled offense. So it has been included as the offense of willful attempt to evade tax in relation to undisclosed foreign income and assets as a scheduled offense under PMLA, and hence you can get a notice under PMLA because of an order which is passed under the BMA, and that is actually happening. So as we see the trail of BMA Act, it has come into play on 1st April 16. This is a much sterner law and places the entire burden of proof on the assessee. Please remember, unlike any other acts, BMA, the burden of proof is on the assessee. The act is to basically overcome the limitations of the Income Tax Act, and the proceedings will test cases which are related to trust beneficiaries, shareholders. And now the taxman may get information on the various securities and on the various bullion, the jewelries, the paintings, etc. And the tax authorities will become more and more aggressive on the same. So how it actually happens? So the administration, as you all know, is currently with the Income Tax Department, and with a view to have more and more expeditious and efficient administrative framework for the implementation of BMA, for achieving the objectives of the BMA. The CBDT has now authorized either DG investigation or the principal DIT investigation to give concurrent jurisdiction to the AO. That is, so what happens under BMA, the DC, the deputy director investigation can also pass an order. So unlike the Income Tax Act, where we have a deputy commissioner or the assistant commissioner or income tax officer, under BMA there is a concurrent jurisdiction which is available with the department. So some of the cases are being adjudicated or decided by additional commissioners of the central range, or some of the cases are decided by the deputy director investigation at the investigation wing. So depending upon what the department wants, they are deciding. But yes, definitely, since the investigating officer or the investigation wing of the Income Tax Department is having more data, they prefer to do the assessments under Section 10(1) of BMA by these deputy directors investigation rather than by the central range. But yes, we have handled both at this 31st March 22, and definitely the the feedback, or what we need to learn is most of these cases are in favor of the revenue, unlike some of the exceptional cases, for example, cases where it has been already offered, or in case of a person which brings to the attention of the authorities under BMA that it belongs to a person which is a non-resident, then it is all right. Otherwise, in other cases, it is a difficult proposition. Not only that, now the department, that is the respective assessing officers, are also passing penalty orders for the orders which have already been passed earlier by their predecessors. And these penalty orders are mainly in two aspects, which we'll see in slides to come. For non-disclosure of the asset under the FA schedule, and second is also for the penalty, which is 3 times. So 10 lakh rupees for non-disclosure, and 90% of the tax amount for non-disclosure is something which is passed by the officers. As we all know that in Income Tax Authority, to get stay, you typically pay 20% and get stay. Unfortunately, there is no such concept of getting stay in a BMA Act, and they try to pressurize us to make more and more payments. But unfortunately, we have yet not tested yet for stay, but it seems difficult to get a stay unless we pay additional amount in something which you already paid under income tax. So although there is no time limit for issuance of the notice of Section 10(1) as stipulated under BMA, wherever the conditions in respect of issuance of notices are satisfied, AO is required to issue the notice within 30 days from the previous year, 30 days from the end of the previous year in which the information was received or has come to his notice. Once the investigation is initiated in an undisclosed foreign asset case, proper references are available under the tax treaties or the legal instruments should be made to the relevant foreign jurisdictions at the earliest, and preferably within 21 days of the initiation of the investigation. Meaning thereby, suppose there is a case where it requires a reference to be made to a foreign government, that is an FTTR for FT and TR references to be made to a foreign country, then definitely to that extent the assessing or the officer will have to wait, and once he gets the information back, then he will have to issue a notice within 21 days of the notice of that information. Then obviously he will have to, in case the information is not received by the concerned authority, then every 15 days he will have to make a follow-up to the FTTR. And this FT and TR is basically located at Delhi in the CBDT's office, and they in turn ask the information through the FIU to the various governments abroad, and information then comes to the FIU, FT and TR, and then to the local investigation wing of the government of India, and then investigation gets forward. So as we already discussed, friends, as regards penalties, the minimum penalty or the penalty which is usually imposed upon the people is 3 times. Section 41 of the Act becomes amply clear, and the BMA Act makes it very, very clear that as far as penalty is concerned, that 41 says that the assessing officer may direct that in cases where tax has been computed under Section 10 in respect of undisclosed foreign income and asset, the assessee shall pay by way of penalty in addition to tax a sum equal to 3 times the tax computed under that section. And so it is very, very clear that Section 41 that the penalty, the minimum or maximum penalty is 3 times of the tax which is imposed. And what happens for the failure to furnish return of the foreign asset? If a person being a resident other than not ordinary resident in India and he has failed to furnish the return of income, then as we see, there is a penalty for non-filing of return of income under Section 139(1) of a foreign undisclosed asset or income. Then that amount of penalty is rupees 10 lakhs. For non-disclosure or even incorrect disclosure in the return of income of a foreign asset, then it is 10 lakhs. They say that there is no penalty in respect of asset being 1 or more bank accounts if the aggregate value does not exceed 5 lakhs at any time during the year. In case of default in tax payment, again the penalty they are saying is equal to the tax amount. So again it's very, very draconian. In case of any other defaults, we see, for example, Section 45, that is a person shall be liable to penalty in case he fails to answer any question put to him by a tax authority in exercise of powers, if he fails to sign any statement made by him in the course of proceedings under this Act with the tax authority, if he fails to attend or he fails to produce the books of accounts or any documents at the place of time he is required to attend, or to give evidence or produce books of accounts at a place mentioned to him in Section 8, the penalty in such cases shall be not less than 50,000 but be extended to 2 lakh rupees. Very, very harsh, friends, but be very careful. I request all our fellow brothers and sisters to be very careful that in case of BMA, whenever you are answering any question, please don't take it lightly. You will have to be careful of answering any question. What about appeals? Section 15 of the BMA Act talks about appeals. And these are the same people as of today. There is a CIT Appeal 51 of the, as far as Mumbai cases are concerned, which have been taking up the cases of the Black Money Act, and Section 15(1) of the Black Money Act allows appeal before the CIT appeals. And is the same CIT appeal who has jurisdiction, and you will have to file it manually after even after migration to faceless. as far as BMA is concerned, it is yet offline. It has to be done physically. Again, the feedback from the cases of which have gone to the CIT appeal is not very positive, and is something you will have to wait till the case comes up before a tribunal, because the CIT appeals as far as BMA Act are also taking the view which is very, very stringent, and which is something which is not for the assessee. What about the budget of 2022? The budget of 2022 again has brought about amendments. These amendments, although have been made to the Income Tax Act by way of Section 68, I'm sure all of you are aware that now even loans are being considered. If they are not properly, the source of such loans or borrowings is not properly examined or revealed, then such loans will also be added to the taxpayer's income. Previously, the equity investments, the source of which was not explained but treated as taxable income, now the same is being applied even to the loans and for borrowings. And if the taxpayer cannot identify the source of funds for the loans which have been borrowed, then they will be added to his income. The endeavor of the amendment is to defer or deter the practice of conversion of unaccounted money which was being carried out through the masquerade of loans or through the borrowings. So friends, thank you so much for giving a patient listening, and I'll be very happy to take up any questions, or I'll be happy to take up any discussions as the case may be. But once again, I would like to thank JCAF. I would like to thank all the organizers, and I would like to thank each one of you for giving me such a patient listening. Thank you once again, and thanks to Chairman Sir for being there till the last moment also. Thank you, sir.
So right now we do not have any questions coming up. So if anyone wants to ask Shardul sir any question, can post on the chat box. So Rajesh sir, if you want to give any comments for after the session, your expert advice.
Yeah, thank you. Shardul, that was absolutely great. You have gone to great depths in the whole process, and done a very good surgery of the whole thing, especially with the case laws, and especially with the latest case law of Leena Gandhi, which was a very good judgment. I'm talking more with reference of if the audience over here would have seen a lot of big names coming up, the cases starting from Chidambaram by the Madras High Court and then down to the other cases. So perhaps everybody would be thinking कि BMA means जिनके black money होता है Swiss bank accounts में या abroad होता है, ये सिर्फ बड़े-बड़े लोगों के लिए है, छोटे-छोटे लोगों के लिए नहीं है. But friends, just to share, and CA Shardul can add some light on this, that in day-to-day life, at a very small and medium level, we have cases like, students going abroad for studying for a couple of years. माँ बैंक अकाउंट खोल देते हैं, कभी कभी they make some little bit investments over there. We have some people have gone abroad maybe for 1 or 2 years on service, on deputation, software engineers. They open bank accounts, कुछ mutual funds वगैरह ले लेते हैं, and then they come back to India. And after a couple of years, it's like, oh, मेरा बैंक अकाउंट है, मुझे याद नहीं है, या हाँ वो थोड़े बहुत शेयर्स पड़े थे मेरे माइक्रोसॉफ्ट के लिए हुए थे, वो अभी याद नहीं आ रहा है. And they just simply forget, or perhaps they don't think it is relevant, or perhaps, with all due respect, some chartered accountants have also not asked this question that, sir, do you have any foreign assets or any foreign income? और ये चीजें इग्नोर हो जाती है, and that's why triggers like this happen, though there is a limit of up to about $500,000 rupees, 500,000 equivalent of INR equivalent in dollars. If you have in your foreign bank accounts and if you have not disclosed it, to some extent it is okay, though take it with a pinch of salt, but not with a lot of other assets. So Shardul ji, I just wanted to know that these type of SME cases में जहाँ थोड़े बहुत शेयर्स, थोड़े बहुत डिबेंचर्स, कुछ छोटी मोटी चीजें लोगों की आ गई है, lying in the bank accounts, lying in some demat accounts, is the department also coming down on them so heavily? Leena Gandhi was a case where it was $275,000, but I'm also talking of these small time cases. So does it really come down so heavily on these kind of SME cases? Any case laws?
So Rajesh bhai, very, very pertinent question, and I must thank you for bringing up the same. So what is happening is under the exchange of information, which India has already signed with various countries, and it's also continuously signing, the FIU, it is like a funnel. So the FIU at Delhi gathers information from cases around the world. They also see the cases, how much of an economic impact they have on the country, and also the financial impact which will have on the society at large. So you are absolutely correct that filtering happens at New Delhi, the filtering happens at FIU level and also at the FTTR level. So in case of certain cases which are small or irrelevant, then it will be directly passed on to the assessing officer, and the assessing officer will probably bring out a notice under the Income Tax Act if possible, and only in cases which are of higher magnitude or which are having financial repercussions, then definitely which will be brought, information will be given to the investigation wing of the authorities of the local investigation authority, and they only after doing their own due diligence, and again it could be of higher financial impact or magnitude. I have been told that informally the ticket size in Mumbai is 50 crores. So because they don't have the manpower, they don't have the bandwidth for carrying out a search or a seizure operation. So in case of a search and seizure operations, it goes to 50 crores and above. But for the smaller cases, it is called STR. You are aware of STR and other cases where there's suspicious transaction reports, and there are basically other I forgot the other name, but there are other manners in which the income tax department sends notice through the investigation wing, but definitely searches will not happen in those cases. But as chartered accountants or as professionals, if some people come like this to us, the best thing is for us to advise them is to report in their income tax return, whether it is even a small bank account or whatever it is. If you have become a resident of the country, then you disclose. If you continue to become non-resident or you are not ordinary resident, you don't have to. But in case you become a resident and in case it is a foreign asset, then you better disclose, even if you do not have any income which is coming out of it.
Thank you, Rashish. Thank you so much. I also would like to bring up that one more topic which was in the Rashish Bhansali judgment, which is that there is a foreign asset abroad. कोई भी asset हो, it may be a bank account, it may be a immovable property, or it may be mutual funds, and that bank account has been closed, or that flat has been sold off, or that mutual fund has been surrendered, और ये बात खत्म होके 10 साल हो चुके हैं. Now suddenly the BMA authorities realize, oh, you had a bank account, or oh, you had a residential flat in New York, or you had some mutual funds in Australia, और उसका नोटिस अभी इशू किया जाता है कि आपके पास तो ये था, and the assessee says कि मेरे पास था लेकिन मैंने तो बेच दिया उसे, so it's no longer there. So this is keeping in mind Shardul ji Rashish Bhansali का, because उसका कुछ similar question raise किया था. तो maybe this must have happened when the person must be a non-resident. Today he's a resident, or let's take a scenario that he had that asset when he was a non-resident, then he came back to India, he was a resident, and maybe during his residency days that asset must have been liquidated. Possible, we can take either kind of a scenario. Any inputs on this, Shardul ji, for our viewers?
No, so my response to Rasesh Bansali is, so I have studied that case, and I find that the ITAT has taken a very, very one-sided view. It could be in favor of the assessee. It could have, in fact, been put it back to the AO. But the way Pramod Kumar ji has gone, it's one-sided in favor of the department. And I am feeling very, very sad about that case. And as you rightly mentioned, if the assessee brings about a lot of evidence, it brings about an explanation, you can always send it back to the AO. Let the AO re-verify. You cannot have a one-sided negative view upon any. And this person, unfortunately, what I again heard from the department, he tried to do a lot of mischief during investigation. He used to play games. Last minute he did not disclose his assets. Just 3 days before, he brings about a story that these papers were lying at some point of time. So yes, that again, you have to read the body language of the person. And you have to also read, that you cannot play game with the department. Department ke saath you have to have a consistent approach, and that has to be, something which is forthcoming, something which is, very submissive in nature. But I have heard that he tried to play a lot of game And as you know, in ITT, it became worse because Pramod Kumar sir was there, and Pramod Kumar sir, and I heard it was getting argued at some level by Mr. Pardiwala. And
Mr. Pardiwala appeared.
yeah, no, but at in 3 days continuously, sir. The last day, because it was going on one side, Pardiwala did not come, and then Madhur Agarwal had to come.
Yeah.
But the way it was going, in 3 days flat, the case was heard. And I think sometimes, you know, the judges have to be very, very judicious, but sometimes the perception plays a very different role. Unfortunately, if you see other case law, for example, Yash Billa's case, the last date of the precedent, the assessee could manage it so well, and Mr. Bhatt gave a very favorable order. But again, in Yash Billa's case, it was little different facts, but a very favorable decision for the assessee. And we have another negative case of Mr. Thadani. And as you know, Thadani's case is also something which is, although it is different on the facts, but it is against the assessee. So the department is continuously harping on Thadani. And now they have Mr. Bansali's case again to, make them.
True.
Thank you.
Anyway, thank you so much, Shardulji. That was very kind of you. Just a few practical points for the viewers, so that they can understand the intricacy of BMA, as very beautifully explained. कि एक छोटी सी गलती भी in filling up the FA part for residents can be absolutely suicidal. So especially when there are any kind of implications by this, I suppose Shardulji will agree with me कि अगर कोई juniors कर रहे हैं इस type का return, तो प्लीज सीनियर्स का सुपरविजन होना बहुत जरूरी है, otherwise it can just backfire. Nowadays even the issues of belated return is getting limited, and you have now this you can have an updated return. We have to see still in that model fixed foreign assets will come, not come, etc. But yes, this act has acquired absolutely draconian view. And it is also having its tentacles now into PML and other areas, as it has been already mentioned by the speaker, sir. So very grateful to you, sir, for this extremely rich enlightenment on this issue. And thank you so much, Charmi ji.
We have one question in the chat box, sir. It's rupees 5 lakh in a single bank account or aggregate of securities and bank balance. Is it exempt?
It's the aggregate.
Yeah.
Aggregate, yeah. What Shardulji is saying, it is the aggregate. 500,000 is in the aggregate in the bank accounts, not per bank account.
Is it like that it is an exemption, or it is basically that no penalty will be imposed in cases of up to 5 lakhs aggregate?
No penalty, sir. No penalty.
Yeah, so tax is payable in any
30%, yes.
Yeah. So it is not an exemption like that. Fine. Good.
Yeah. So
it can all be bank deposits and not basically securities or mutual fund or any other asset.
No, there was, Shardulji, there was a nice question now asked by somebody, ke supposing koi aaj jaag gaya, and let's say the current return 22-23 or maybe 21-22 mein shayad, they disclose the foreign assets, but they have not disclosed the foreign assets in assessment year 19-20, 18-19, whatever. But suddenly aaj unko, they got this enlightenment and they have shown it in the returns. And it's a resident case. So now the question, will BMA be attracted because in the current year you are showing, and in the prior years you have not shown those assets? So what can be the consequences? I think so that is a question which the gentleman wants to ask. Shardul ji.
The answer is that we are handling one such case, BMA is applicable.
Applicable, yes, very true. BMA will be applicable. So let this not go as a signal that if there is a mistake going on, continue with the mistake. That is also not the way it has to be done. It's a law, one has to abide by it, but yes, one has to face the issues. Thank you so much, Shardul ji. Charmi, over to you.
Thank you, sir. This comes to the end of all the questions, answers. The beautifully portrayed in-depth knowledge shared by Shardul sir, and also from Rajesh sir, we got very good insights at the start, at the end of the session. Thank you so much, sir. And Shardul sir, thank you for giving your valuable time, in-depth knowledge with our participants. On behalf of JCF, I give a hearty vote of thanks to you. Thank you so much, sir.
Thank you, everybody.
Thank you.
This brings our this series, Embrace the New Changes. This was the last lecture, so this series comes to an end. We all are thankful to you all for being present in all the sessions. Most of the sessions, most of the audience we see are repetitive, and we are really thankful to today's chairman Rajesh Sanghvi, who agreed at a just WhatsApp message about chairing this session.
Welcome.
Absolutely, it's his humbleness that he is always with us at JCF. And Shardul Bhai, of course, he himself suggested while talking to Hiral that this is the topic we can bring for the benefit of audience, JCF members, and everyone. And of course, it was really, the session was immensely helpful to everyone who was present. And I think we need to be more aware, more careful while preparing returns for residents who have especially migrated back to India from abroad, and to save them from miseries, because the defaults are really going to be highly punitive. As Rajesh Bhai said, these are basically punitive laws. Yeah. Thanks a lot, everyone.
Thank you. Thank you.